ஓகே சுசாலி, ஒருவேளை நீங்கள் எப்படி இந்த எடுத்த எல்லாம் இதாக்கிட்டு வேற
Okay. Hi, Yunus. I'm just waiting for a few minutes in case somebody wants to join. Yeah, my screen is shared. So the plan for the day is depending on who joins, okay? Because, yeah, since we have somebody who is not part of our main lectures also joining, the plan is we will be doing 2 questions based on working capital management, because that was an area that we didn't really do many questions. We did risk management, we did business finance, but working capital management, we didn't do much. So we will first do 2 questions based on that. And then, let me just check. So we have 2 of you in. So my initial plan was to do a few questions from the pre-mock, because I will be doing, I plan to do it on the last day of the TRG, but because this is just 3 hours, it won't be enough to cover the entire paper. Okay, so my initial plan was to do a little bit of the pre-mock, but in case, nobody from outside or very few outsiders join in, then I might decide the last hour to do 1 more question. Okay, most probably based on business finance or business valuations. Okay, so for now, let's finish off the 2 questions to do with working capital management, and then we'll decide what to do in the last hour. Okay, the reason why I'm saying that Shagana is because I had already covered the pre-mock in one of my classes that I had on Sunday. So Yunus has already done it, so I don't want to do it again if more of the students who are in that class are in the TRG. But if there are more students who are from the outside, then I will take some time and do the pre-mock. And what is this pre-mock? It is an exam that was released by ACCA on the 12th of February. And they release a mock exam before every exam sitting. So for the March 2024 sitting, they released a pre-mock on the 12th of February. And it's a very good idea to actually do that paper, because there's a very good chance that the areas that they tested in that pre-mock is actually going to be part of the actual exam in March. So that is why we give a lot of weightage for that pre-mock paper. Okay. So even if I don't do it, don't worry. I have anyway planned for the last day of the TRG to be just for the pre-mock. So the most important parts I will definitely cover. Okay, right. So let's start off with this FLG company. It's part of your Kaplan revision kit. It will be on page 119 if you have the latest version. Okay. So it says here, FLG has an annual credit sales of 4.2 million and cost of sales 1.89 million. Okay, they're giving us the sales and the cost of sales. Current assets consist of inventory and accounts receivable. Current liabilities consist of accounts payable and an overdraft with an average interest rate of 7% per year. Okay, so they're telling us that under current assets, usually we have inventory, trade receivables, and cash, right? Usually in a balance sheet. But here they are telling us that under current assets, we are only having inventory and accounts receivable. And under current liabilities, they're saying we have accounts payable and we have an overdraft. And that overdraft has an interest rate of 7 per year. Okay, so that is pretty straightforward. The company gives 2 months credit to its customers and is allowed on average 1 month's credit by trade suppliers. So our customers will pay us money in 2 months' time. And our suppliers, we pay them in 1 month's time. Okay, so that is the scenario. It has an operating cycle of 3 months. Okay, so you should know what an operating cycle is. It is basically your inventory days plus your receivable days minus your payable days. Okay, so inventory period plus the receivables period minus the payable period, that is the operating cycle. So they're telling us that the answer for the operating cycle is 3 months. Then we have other relevant information. Current ratio of FLG is 1.4. Cost of long-term finance of FLG is 11%. Now remember, they're saying the overdraft is 7%. Overdraft is always a short-term source of finance. Long-term source of finance, it will cost them 11%. So if they have to go for a bank loan or something, they will most probably have to pay an interest of 11%. That's what they're trying to say. A part is saying, discuss the key factors which determine the level of investment in current assets. So they're asking you, what will the company have to think about? What are the factors they will have to consider when they are thinking about how much inventory to have and how much trade receivables to have? Okay, so what are the factors that we will have to think about when we are going to decide how much of inventory to have in our organization and how much of trade receivables can we have in our organization? Okay, so you can just think of it. They're just talking about 4 marks. So if you can just make 4 brief points, that will be more than enough. Okay, so think about it. One thing that can pop, the first thing that I can think of is, when it comes to the trade receivables, okay, when it comes to the trade receivables, the amount of trade receivables that I have, it will maybe depend on the industry that I'm in. It will depend on my competitors. Okay, so for example, if my competitors, if they are going to give customers 2 months credit, okay, they're going to give customers 2 months credit, and I go and give only 30 days or 1 month credit, then definitely the customers will opt to go for my competitor because they get more time to pay the cash that they owe the competitor. So one thing that can determine how much of trade receivables I have could actually be the terms of trade. Now, in that industry, if it's a norm for me to actually give a lot of time for trade receivables to, pay up their debt, then chances are that obviously the trade receivable balance will be higher. Okay, that's the first thing. Another thing I can think of is depends on my approach to risk. Now, if I have a conservative approach, meaning I don't want to take too much of risk, then I don't want to be in a position where I have a stock out. I don't have inventory. I don't want to be in a position where my receivables don't want to do business with me anymore because I'm not giving them enough time. So if I'm a conservative person by nature, then based on, the way I think of, the way I want to run my business, I will definitely make sure that the inventory levels are high because I don't want a stock out situation. And I will make sure that I give my receivables also sometimes. So that balance also will be higher. Suppose I had an aggressive nature. Aggressive means I want profits. I don't care about the working capital, whether there is cash, whether there is no cash, whether the inventory is going to get stocked out. All of those things are secondary for me. I want profit. So I am aggressive. The thing is, if I invest in current assets, inventory, trade, receivables, it's not going to earn me a profit. Obviously, no, it's just money being tied up in inventory and receivables. So if I have an aggressive approach, then what will happen? I will end up investing a lower amount in current assets. Okay, so those are the two things that actually came to my head, should have come up in your head as well. Okay, those may be two factors that we can consider. Right, so let's just go through the answer here. It says, there are a number of factors that determine the level of investment in current assets, and their relative importance varies from company to company. The first thing they're talking about, the length of the working capital cycle. Okay, so what is the working capital cycle? It is the amount of time between you paying your supplier. Yeah, the amount of time. It starts at the point where you pay your supplier, and it ends when you receive cash from your customer. Okay, so now if the period between you paying the supplier and your customer giving you the money, if it is a very long period, then naturally you will have to invest more in the receivables, because the receivables are going to take a longer time to pay you. So automatically trade receivables will be a higher figure. Okay, so that's what they're trying to say here. Operating activities during this period, that is the time between you paying the supplier and the customer paying you, it has to be financed. And as the operating period lengthens, the amount of finance needed increases. So for example, if we have already paid the supplier and our customer is not giving us the cash, within that period, then what will happen? You have to find somewhere else to get the money to run your day-to-day. To run your day-to-day business, because we have already paid and we are waiting for payment. We don't have cash in hand. We might have profits, but we don't have cash. So we have to find out a way to either take a loan, take an overdraft, do something and make sure that we have cash in hand to run the day-to-day business. So one thing that can affect, again, the level of investment in current assets is this working capital cycle. Next one, I told you about this, the terms of trade. Okay. It says, these determine the period of credit extended to customers, any discounts offered for early settlement or bulk purchases, and any penalties for late payment. A company whose terms of trade are more generous than another company in the same industry or sector will therefore need a comparatively higher investment in current assets. So more or less what I said. Yeah, depending on the kind of credit that your competitors are giving the customers, you will have to also kind of be in line with that. Because if you are not going to do that, then that will on its own be a reason for you to lose business. Okay. This one is an important point. Policy on the level of investment. A company with a comparatively conservative approach to the level of investment would maintain higher levels of inventory, offer more generous credit terms, and have higher levels of cash in reserve than a company with an aggressive approach. Because if you're aggressive, it would be more profitable because of the lower level of investment in current assets. It would also be more risky. So if depending on the kind of policy that you have, if you have a conservative policy, automatically your investment in current assets will be higher. If you have an aggressive policy, it will be lower. Finally, you can talk about the industry in which an organization operates. It says another factor that influences the level of investment in current assets is the industry within which an organization operates. See, some industries like aircraft construction will have long operating cycles due to the length of time needed to manufacture finished goods. So depending on the industry, the norms of the industry, how much you invest in your current assets, it will definitely change. Okay. Now, when you see 4 marks like this, guys, you have 2 options, right? Either you can make 2 well-explained points. Okay. So for example, you can just talk about the policy and the industry, but it has to be explained well. Okay. Or you can make 4 points and all 4, it doesn't have to be explained to that detail. You can just make the point and leave it at that. So whatever you are comfortable with depends on the question. Okay. Certain questions you will be happy to explain. Certain questions you can't really think of anything. So, you can just make 4 points randomly. Okay. So it's always safe to make 4 points. But if you can explain a point properly, then please by all means do that, because there is a good chance that they can give you 2 marks for a well explained point. Okay. So that's the A part. B is saying briefly discuss the ways in which factoring can assist in the management of accounts receivable. So they're saying briefly discuss how factoring can help with management of accounts receivable. So first you have to understand what is factoring. Okay, what is factoring? So it's like this. If you are a business and you have receivable balance, that means there are customers, they have not paid you yet. You have an option of either doing the job of collecting the money from them, the administrative job, basically sending them an email, giving them a call, visiting them, asking them, please pay because you have a balance. So you can do that, or you can ask somebody else to do it for you. Now you will have a question, why on earth are you asking somebody else to do it? You can do it now, just to call. The thing is, if you have a lot of receivables, okay, one thing is it's going to take a lot of your time. The other thing is, I don't know if you will agree with me, certain people will actually pay only if you ask them in a, in a way in which they will actually get scared of you. Okay, so if you're a small business, your customer is a big customer, you can't go and, play with them, because they will say, no, not yet. They're just going to take a lot of time. Okay, so if you feel that you don't have the capacity to actually make your customer pay, then it would be a better option, rather than you wasting your time trying to do this, ask somebody who is good at it to actually ask your customer to pay you. So who is this person who is good at it? They are the factor. It can most of the time be a bank. So what does this factor do? They take over the administrative responsibility. So what do? They use their expertise. Okay, so now their job is itself to make people pay, right? Whether it be a loan and the interest, whatever it is, their entire business is all about making people who have taken money pay that money back. So definitely they, in terms of administrative, the administrative work that has to go into this, they will definitely be better than us. So if we give the factor the responsibility to collect debt, because they are anyways good at doing that, and because that is their expertise, it will definitely help this company. Okay, so that is factoring. We are not good at it, so we ask somebody who is good at collecting debt to do it for us. We pay them a fee. So they will give us whatever the receivables gives, but we have to pay a percentage of that to them as a fee. Okay, that is one type of factoring. Another type of factoring is where we not only make the factor do the admin job for us, we also tell the factor, see, I have so much of people who have to pay me, right? So I am not somebody with nothing. I also have people who owe me money. So I am not a poor person. So I can ask the bank, keep this as a guarantee and give me some money upfront, because I need it to run the business. It makes sense. No, I have people, that it is clear. So you can collect the money from them. That's what you're good at. Meanwhile, just to help me out, can you just, give me a portion of that receivables balance? And the bank can agree. Again, you will have to pay them a fee for that. That is another type of factoring. Okay. Now, when the factor is giving you capital upfront, they can do it under 2 different types of agreements. The first one is called without recourse. Okay. Without recourse means, just remember it like this. Without recourse means nobody can come and ask you for any money. Now, suppose your customer defaults, he dies, he goes bankrupt, something happens, he doesn't pay the bank. Now, if the factoring agreement is without recourse, that means the bank can't come to you and say, there was a bad debt, now you pay that amount. Because it's without recourse. They are like, giving us an insurance. If it is with recourse, that means suppose the customer defaults, then the bank can actually come to you and say, look, this customer defaulted, now you pay it. It's up to you. Bad debt, you pay me. I couldn't collect it. Okay. So those are the 3 things that you have to remember. In simple words, first, how does it assist? Because the bank is better at admin than us. Next one, we can ask for a little bit of capital as well. If we do that, we have to decide whether we are going to go for with recourse or without recourse. With recourse means the bank can come to you and ask you to pay an amount that has become a bad debt. Without recourse means the bank has to deal with the bad debt. They have to, accept it, and they are going to be responsible for that. So 3 marks, you don't have to explain so much. You can just make 3 points. I gave you 4 actually. Easy 3 marks for you to get. Okay. So see, three areas have been highlighted. Factoring involves a company turning over administration of its sales ledger to a factor, which is a financial institution with expertise in this area. Okay. The factor will also offer finance to a company based on invoices raised for goods sold or services provided. You don't have to explain all of this, right? Because it's only 3 marks. If you can just make the points that are highlighted, that's more than enough. Then it says, if factoring is without recourse, the factor rather than the company will carry the cost of any bad debts. So without recourse means, remember, nobody can come to you and ask you for money after that. Without recourse. So the bank can't come and ask you for anything. If there is a bad debt, the bank has to deal with it. They have to carry that cost. So if you make those 3 points, you will definitely get your 3 marks. Okay? Right. Now, let's look. You can see the amount of weightage we have given for theory, guys. 4 plus 3, 7 marks out of 20. They have given it entirely for theory. Okay. Now, let's do the calculation. So, it says here, calculate the size of the overdraft of FLG company, the net working capital of the company, and the total cost of financing its current assets. Okay. So let's go one by one and see the information that we have. So first they're asking me to calculate the overdraft. Okay. So there we have the credit sales, we have the cost of sales. So let me just write everything that we have. We have the sales, which is 4.2 million. Okay, in millions. Then we have the cost of sales, which is 1.89 million. Then they're saying current assets consists of inventory and accounts receivable. So current assets, that is, we're talking about inventory plus accounts receivable. And current liabilities is the accounts payable plus the overdraft. Okay. So the question is asking us to get the value of this overdraft. Okay. Let's see. The company gives 2 months credit to its customers and we are allowed 1 month credit. That's fine. Other relevant information, they are giving us the current ratio. That is how much? 1.4. Okay. Now, when you see this current ratio, you have to understand that we calculate current ratio by taking the current assets and dividing it with the current liabilities. Okay. In other words, to get this 1.4, what we have done is 1.4 equals to, what was the current assets? Inventory plus accounts receivable. Okay. Equals to the inventory plus the accounts receivable. And that we are dividing it by the accounts payable plus the overdraft. Okay. Now, if we can figure out a way to calculate the inventory, the accounts receivable, the accounts payable, these 3 figures, then we have all the components of this fraction. So, if only the overdraft is the value that we have to find, using this 1.4, we can easily do that. Okay. So, let's see if there is a way for us to calculate inventory. Okay. So, we know that it has an operating cycle of 3 months. They're telling us that. They're also telling us that we have 2 months credit to its customers, and we are given 1 month credit from our supplier. So let's give the correct names for this. Okay. We can give our customers 2 months credit, means that is called the receivable days. Receivable days. So that is how much? 2 months. The supplier is giving us time, means that is called the payable days, and that is 1 month. Okay, 1 month. And we have the operating cycle, and that is 3 months. Okay. Now, if we need to do something with inventory, if we have to calculate this inventory, we need inventory days. Okay. Now, let's see if there is a way for us to calculate inventory days. We know this equation, operating cycle equals to the receivable days plus the inventory days minus the payable days. Okay, we know that there is an equation like this. So let's input the data that we have. Operating cycle, we know it was 3 months. That should equal to the receivable days, which is 2 months. Plus the inventory days, we don't know. So let's just put it as inventory days itself. Minus the payable days we have, which is 1 month. Okay. Right. So now, if we rearrange this, it will be 3 minus 2 plus 1. This should give us the inventory days. So 3 minus 2 is 1. 1 plus 1 will be 2. So the inventory days will be 2 months. Okay. So now I have the inventory days, I have the receivable days, I have the payable days. I'll give you a minute, see if you can figure out how to calculate inventory, accounts receivable, and accounts payable. Okay, so I'll put that figure as well here. That is 2 months. So to do working capital management, guys, you have to have a good grip on the equations. Okay, the payable days, receivable days, operating cycle, quick ratio, current ratio, all of those equations you have to know very well. Only then you will know which equation to use where. So for example, if you didn't know that there is an equation that connects receivable days, receivables, and the sales. If you didn't know that, then you wouldn't be able to even think of what to do in this question. Okay. Right. So now we want to find inventory, right? So there is an equation that looks like this. Inventory days equals to the inventory divided by the cost of sales. Okay, the inventory divided by the cost of sales, and we multiply that by 3. Usually we multiply it by 365. But in this case, inventory days and all are given in months, not in days. So we have to multiply this by a monthly figure. So that is, in 1 year, we don't have 365 months, we have 12 months. So we multiply this by 12. Okay. Now we can put in the figures that we have. We know that inventory days is 2 months. Okay, that should equal to the inventory is what we want to find, divided by the cost of sales. Cost of sales, it was already given to us 1.89. Okay, 1.89. And we multiply this by 12. Okay, so inventory divided by cost of sales multiplied by 12. So use your calculator. Don't waste time rearranging anything. Just put it as it is. 2 alpha equals, open your fraction. The inventory will be X. over 1.89. This has to be multiplied by 12. Shift calc, you'll get your answer. Inventory is going to be 0.315 million. Okay. So let me write it here. Inventory $0.315 million. So actually you can write this as a normal number itself. That will be 315,000. Okay. So I'll write it in millions as well in case you get confused. But if you see 0.315 million is 315,000. Okay. So that's inventory. So we have inventory. Now let's do accounts receivable. Right. So let me copy this over here just to keep all the information in one place. I'll put it next to the inventory itself. Okay. Now let's do the receivable. So there is another equation called receivable days equals to the receivables divided by receivables comes from sales, right? So divided by sales, and we usually multiply it by 365, but here we are talking about months. So we multiply it by 12 months. You can put in the figures. We know that receivable days was 2 months. Let me copy it. This should equal to the receivables balance. That's what we want. Okay, so let me just write it as receivables itself. Sales, we had a figure. Okay, it was 4.2 million. So let me copy it. Okay, and this you will multiply it by 12. Right, so again, don't waste time with anything. Just put it as it is in your cal. So it will be 2 months should equal to X is the receivables balance. But this time we are going to divide it by the sales, which is 4.2. Shift calc equals 0.7. Okay, so the receivables is going to be equal to 0.7 million. 0.7 million is also 700,000. Okay, so let me copy this as well. And let me write it next to the receivables. So we have inventory, we have receivables. Now, if we have only the payables, we can find out what the overdraft is. Okay. So for payable days, there is a similar equation. You must be familiar with it. Payable days equals to the payables okay, the payables divided by, usually we use the purchases, but since we don't have it, we can use cost of sales and we multiply it by 12 months. Payable days, it was 1 month. That should equal to, again, the payables balance. That's what we're trying to find out. Divided by the cost of sales, which was 1.89, multiplied by 12 months. Underline this. Okay. So again, you can put it as it is in your cal. Just change the 2, make it a 1. X is the payables. The denominator will not be sales, it's cost of sales, 1.89. Into 12 is the same. So shift, solve. Payables is 0.1575 million. $0.1575 million, which is also, yeah, you can write that as 157,500. Okay. If you are confused as to why I'm writing it like this, see 0.1575 million, right? So million means it has to have 6 zeros. So if I have to bring this decimal point 6 places forward, it will be 1, 2, 3, 4, 5, 6. So you have to add 2 more zeros and there will be a comma in the middle. Simple. That's why I'm saying 157,500. That's the payables. Okay. So let me put that here as well. Now we have everything that we need to calculate this overdraft. A good idea will be to highlight this. Okay, because this is an important answer. Now, without this, you can't calculate the overdraft. So the examiner will be looking to see if you have found these figures. So if you highlight it, it will make life easy for him and he'll be able to give you the mark quickly. Okay, right. So now we have everything that we need to calculate the overdraft. So let me do that quickly. Let's do it on this side. So 1.4 should equal to inventory, which is 315,000, plus the receivables, which was 700,000, divided by the accounts payable, which is 157,500, plus the overdraft. So we need the overdraft. Again, don't waste time. You can again put all of this in the calculator directly. Let me quickly show you how. 1.4 alpha equals, open bracket, open the fraction, 315,000 plus 700,000 over 157,500 plus the overdraft is what we are finding. So alpha x. Shift, solve, press the equal sign. The overdraft is 567,500. Okay. Okay, again, a good idea to highlight this as well. Okay, if you want, highlight it and bold it also because that is the final answer. 567,500. Right, so that was the first part. The first part is asking for the overdraft. The next part is they're asking for the net working capital of the company. Okay. Now, working capital of the company, let me go down. Of the company. Okay. Now, you should know that working capital is current assets minus current liabilities. Okay. So, if you look at the current assets, we had, what were the figures? The receivables, which was 700,000, and the inventory, which is 315,000. So, let me copy this. One current asset plus inventory. Those were the only two current assets that we had. Okay. So I will write it here, receivables, and this was inventory. And that is the current assets. You have to deduct the current liabilities from the current assets to get working capital. So payables is 157,500. And the overdraft was 567,500. Yeah. Payables is 157,500. Okay. 567,500. Okay. So this was the payables and this was the overdraft. So now you can calculate Okay. The net working capital. So that will be this figure plus this figure minus this and this. So that will be 290,000. You can call this net working capital. So that's another answer. This you don't have to highlight it since it's already highlighted on the top. Okay. Then finally, the question is asking you the net working capital of the company and the total cost of financing its current assets. Total cost of financing assets. Right. So if you look at their working capital, they have to be financed, okay, either using the overdraft rate of 7% or using the 11%. Okay. First, you have to decide what are the two figures that we are going to need financing for, right? So the first one will be the working capital. The other one, it will be the overdraft. So for the overdraft, for sure, we know that the interest cost is going to be 7%. So let's just write that first. So overdraft, that's going to be this figure. Okay. And cost is going to be how many percent? 7%. Of this. So that will be 39,725. Okay. So that is straightforward. The only other finance that we need is for this working capital. So let's write net working capital because it's considering receivables, payables, and the deduction. So only other thing that we have to consider is the working capital. So that is 290,000. And usually working capital, you will finance it at the long-term rate. So the long-term rate is 11%. So the cost is going to be 11% of this, which is 31,900. So the total cost will be the addition of these two, which is 71,625. Simple as that. Okay. This is a classic example, this particular question of why, a lot of people say calculations usually take a lot of time and, it's not easy to get the mark. See, it's actually true, right? It's only 6 marks. But we have done so many calculations. But why are they giving you only 6? Because all are simple calculations. Payable days, receivable days, inventory days are things that you know from your A-levels. Okay, so that is why they don't give too much of a mark. But it actually takes a lot of time. Look at that in comparison with the theory questions. 4 plus 3, 7 marks. It wouldn't take you so long to write those 7 points. That's why I always emphasize and say the theory-based questions are the ones that actually give you the marks. Students think that they can do the calculation and get the mark, but that is not true. Take my word for it, it's the theory. You just think of something. If it is slightly relevant, even they will give you that mark. Don't ever leave a theory blank because that is the place where you can actually score. Because now see, if 1 or 2 of this had gone wrong, the calculation is wrong. You can't help it. No, if the answer is not there, it's not there. But theory is not like that. They will try their best to give you the mark for it. Okay. So always make it a point to try the theory. Right. Then let's look at the D part. FLG wishes to minimize its inventory costs. Annual demand for a raw material costing 12 per unit is 60,000 units per year. So the demand is 60,000 units. The price is 12 per unit. Inventory management costs for this raw material are as follows. We have the ordering cost. We have the holding cost. The supplier of this raw material has offered a bulk purchase discount of 1% for orders of 10,000 units or more. So if you order more than 10,000 units, you will get 1% discount. If bulk purchase orders are made regularly, it is expected that the annual holding cost for this raw material will increase to 2 per unit per year. So if you are going to make bulk purchase of 10,000 or more, then the cost of holding will not be 0.5. It will be 2. Okay, so they're saying that there is going to be that change. The first part is saying calculate the total cost of inventory for the raw material when using the economic order quantity. Okay. So this is the part. Number 1. You shouldn't have this problem, guys, because in your exam, if they're talking about D, only D will be there, and under that you will have a separate spreadsheet. So you won't be doing everything in one spreadsheet. Okay. So they're asking you the total cost of inventory when using the EOQ. Okay, so first let's calculate the EOQ because it's not given to us here. How do we calculate EOQ? Let me take you to any formula sheet. This is the EOQ formula. Okay, so let me print this. Hope I can take it here. Okay. So this is the EOQ formula. Using this, we have to calculate the economic order quantity first. Right. So what is the cost of ordering? Cost of ordering is 6. Then we have the demand, which is D. They say the demand is 60,000 units per year. Then we have the cost of holding, which is 0.5. Okay, so we have everything that we need to calculate EOQ. So let me put it in the calculator and show you. You take the root first. Root, and then you put in the fraction. Then we say 2 times the cost of ordering, which is 6, into the demand. It has to be annual demand. In this case, they are giving it as annual demand, so no problem, 60,000. You divide that by the cost of holding, which is 0.5, and press the equal sign. We get the EOQ as 1,200 units. Okay, again, good idea to have it bold and highlighted. The next part is asking you the total cost of inventory for the raw material when using the EOQ. So to get the total cost of inventory, there are 3 different costs that we have to incur. You have to be familiar with this. The first one is the purchase price. Okay, and how do we calculate this? It's going to be the price into the demand. Then we have the ordering cost. Okay, ordering cost, which is going to be the cost of ordering times the demand divided by the E, or not the EOQ, the quantity actually. In this case, we are using the EOQ. Finally, the third cost of inventory is the holding cost. And how do we calculate that? That is the cost of holding times the quantity divided by 2. Okay. Right. So now in a situation like this, it would be easier for you to actually use the formulas. Okay. So let me show you how you can do this. Each of the different quantities that you're going to use, write it in a different cell. So the price is how much? 12. Demand was 60,000. Then the quantity that we are talking about is 1,200 because that is the EOQ. Then we are talking about a cost of ordering, which is 6, and a cost of holding, which is 0.5. Okay. So now let's do each of them one at a time. This is going to be the price multiplied by the demand, which is 60,000. Okay. So that will be 720,000. 12 into 60,000. Yeah, correct. Okay. Then here it's going to be the cost of ordering, which is 6 multiplied by, open a bracket and say the demand divided by the quantity, which is 1200, and close this bracket. So that will be 300. And here it's going to be the cost of holding times, again, open a bracket, the quantity, which is 1200 divided by 2. Again, 300. Okay. So here you can take a total, which is going to be this plus this plus this. 720,600. Good idea, again, to bold it and highlight. Okay, so in this situation, it's easier to formulate everything. Right. 720,600. So that's the first one, 4 marks, easy 4 marks. Then the second is asking you, determine whether accepting the discount offered by the supplier will minimize the total cost of inventory for the raw material. So now you have to get the same total cost of inventory, but this time we are not going to do it for 1200 units, because if we do at 1200, you will not get that discount. The discount only happens if it is 10,000 units or more. Okay. So the same calculation, you will do it for 10,000 units. Okay. Right. So let's copy this and make the changes, right? What's the price going to be? They are saying they have offered us a bulk purchase discount of 1%. That means the price is not going to be $12 anymore. It will be $12 plus a 1% discount. So to get the actual price, it's going to be 12 times 99%. Obviously, no, 1%, 100 minus 1, 99%. So the price is going to be this time 11.88, not 12 anymore. Okay. The annual demand is the same. The quantity is going to change. We are going to order 10,000 units, because only if we order 10,000, we will get the discount. Cost of ordering is the same, and they're saying the holding cost, it will become 2. It's not going to be 0.05. Okay. Now it's easy. Let's calculate price into demand. Okay, so that will be 712,800. Cost of ordering, which is 6 into, open a bracket, okay, in case, demand divided by the quantity, which is 10,000, close the bracket, 36. And here it will be the cost of holding times, again, open a bracket, the quantity, which is 10,000 divided by 2. It will be 10,000. Then you can get a total. Which is 722,836. Okay. Let me bold it also. Now they're saying determine whether accepting the discount offered by the supplier will minimize the cost or not. So we have to compare these two. If we take the discount, we will end up paying 722,836. Whereas when we didn't take the discount, we only paid 720,600. Okay. So if we take up the discount, we end up paying how much extra? Take the difference. Let's just check it here. This one minus 2,236. Okay, so let's just write it here. $2,236 more than if we didn't take it up. Okay. Therefore, FLG, right? The company. Yeah. FLG company should order at the EOQ of 1,200 units and not at any other quantity. Okay. So if you can say this, just saying this itself will give you 1 mark. Okay. So you have to compare the two, and based on the fact that after discount, we are actually paying more, the total inventory cost is more, we will not take up the discount, we will go for the EOQ, and we will order every time 1,200 units only. Okay. Right. So that's all for FLG. Okay. So I'll give you a minute. You can take all of this down. Okay, so we started off with getting an overdraft. Okay, so all of this is just simple inventory days, receivable days, and payable days calculations. Then we did net working capital, the cost of financing, EOQ, and then we have come up with a decision as well. So you can see this question, we start with working capital management, but we have ended up, I mean, we start off with overdrafts and, trade receivables and all, but finally we end up with materials. Okay. But again, everything is part of the entire chapter, working capital management. Okay, so you can take this down, 7:10 now. So yeah, if you can take 15 minutes, that will be 7:25. You can come back and we will look at another working capital management based question. Okay, so take this down and then take a break and come back. Okay, I hope you guys are back. So, yeah, before I start, just something for you, Shagana, Pushparaj. If in case you're sitting for the paper in March, okay, so now if you have just randomly joined this, then it's fine. But if you're going to sit for this paper in March, the thing is now there's just 3 of you know in this TRG. So Yunus and Shan, they join my classes on Sunday. I mean, the usual FM classes that we have. So we have been doing revision in those classes as well. Okay. So ideally for a TRG, there will be one more area that I will definitely look at. And that is this pre-mock that I'm talking about. So in case you're not familiar with it, let me show you that quickly. One second. Because let me show you ACCA FM pre-mock. Okay. So if you go to your ACCA global site, you should see this FM mock exam and debrief video. So you need to access the practice platform. Put in your ID. Okay, and you will be able to, there's like a catalog on the side. So if you go to financial management, ACCA official resources, practice exams, there's this thing called FM pre-March 2024 mock exam. So now it says unassigned, right? So it will be like this. When you see it, you need to assign it to yourself. And then if you look at self-assigned materials, you will have this pre-mock, which you can start. Okay. So my advice to you is please have a look at it and make sure that you do it, and you can mark it yourself as well. So let me show you how it goes. It's just in the exact exam format. Everything is the same. So all your instructions, the sections. Okay, so section A. So you have all the questions that will come one after the other like this. Okay. So once you're done with this exam, you can actually mark it yourself. So if you look at this, it says self-marking. You can choose whichever one it was. Now the FM pre-mock, you can say self-mark. And basically the marking scheme, you will see it. See your answers, if it is correct, and the correct answers, everything will be given. So one after the other, you can keep on marking. So question 1, question 2, question 3, even the long answers, they give it to you. In addition to this, they also release a debrief video. So can you see here? Mock debrief section A and B. They want section A and B. They don't look at all the questions, but most of it they will. And section C, both the questions, the constructed response, they actually go through it. Okay, so make it a point before your exam to do this pre-mock. So according to my plans, I was supposed to do, a little bit of it today and finish it off next week in the TRG. But because it's just, Yunus and Shan have already done it, it will be a waste of their time. Okay. And because we also have the debrief videos, you shouldn't have a problem with actually doing the paper and marking it. Okay. So it is a main area. I would have done it in the TRG if there were more people who are not in my class. Okay, but since that's not the case, I don't want to waste the time of those who are here. So that's why I'm telling you, this is one thing that you have to do before the exam. Other than that, in the TRGs, I will pick questions that are similar to what they have given in this pre-March and make sure that all the areas are covered, and all that I will do. The only thing that I have decided not to do is to do the pre-mock in the TRG because we have already done it in a class before. Okay, so if you have any questions or problems with the pre-mock, feel free to ask me next Tuesday during the TRG. If you have any questions, you can always ask me. I will stop what I'm doing and explain whatever doubts you have. Okay. Right. So what we will be doing now, we'll be doing another question to do with working capital management and another question to do with sources of finance and business finance. Okay. Both important questions, I feel. So let's start off with the working capital management question. So it says here, KXP company is an e-business, okay, that trades solely over the internet. In the last year, the company had sales of 15 million all sales were on 30 days credit to commercial customers. Okay, so all their sales were credit sales to commercial customers. We gave them 30 days credit. Extracts from the company's most recent statement of financial position relating to working capital are as follows. So we have the trade receivables, 2,466,000. Trade payables, 2,220,000. Overdraft, which is 3 million. Then it says, in order to encourage customers to pay on time, KXP proposes introducing an early settlement discount of 1% for payment within 30 days, while increasing its normal credit period to 45 days. So see what's happening. Currently, we are giving our customers 30 days credit period. But we are saying to encourage them to pay on time, we are going to give them 1% discount for paying in 30 days. That means definitely the customers are not paying in 30 days. They are taking longer than that. Okay. So that is why we are giving them 1% discount to pay in 30 days. And now our normal, credit period was 30 days. Now, if you are going to give 1% discount, we have to obviously increase our normal credit days. So that is why we are increasing our normal credit period to 45 days. Okay. It is expected that on average, 50% of customers will take the discount and pay within 30 days. 30% of customers will pay within 45 days. And 20% of customers will not change their current paying behavior. Okay. Then it says KXP currently orders 15,000 units per month of product Z, demand for which is constant. There is only one supplier of product Z, and the cost of product Z purchases over the last year was 540,000. The supplier has offered a 2% discount for orders of product Z of 30,000 units or more. Each order costs KXP 150 to place, and holding cost is 24 cents per unit per year. They have an overdraft facility charging interest of 6% per year. Now, in your exam, guys, first thing you have to understand is we have 2 paragraphs like this. So definitely there will be 2 different requirements. Okay, so one requirement you will be able to do it by just reading the first paragraph. Another requirement only will make you read the second paragraph. Okay, so let's go to the requirements. It says, calculate the net benefit or cost of the proposed changes in trade receivables policy and comment on your findings. So trade receivable policy means we are talking about the first part of the question. So they're asking you to calculate and say, are we going to get a net benefit or are we going to get a cost? So we have a name for this. A part, we are going to do what we call a cost benefit analysis. That's the word we use, cost benefit analysis. Okay. So first, let's look at the cost because the cost is easy. Now by giving this discount, 1% payment, the 1% discount for payment within 30 days, think about it. The only cost that we are really going to incur is that 1% cost because they are going to pay 1% less. Other than that, your customers are going to pay you earlier. So if they pay you earlier, that is definitely not a cost, it's a benefit. Okay. So everything is fine with this, this proposed change. Only thing is that ultimately the amount that you get will be 1% less. So that will be the cost that you have to bear. Okay. So to do this question, we have to know what the sales is, which they have given us. They are telling us that the sales was 15 million. Okay, 15 million. And in this 15 million, they are saying only 50% of the customers will take the discount. Okay, so this 1% loss that you are going to make, it's only going to happen for 50% of the customers. So of this 15 million, we have to incur that 1% loss only for 50%. So 15 million into 50%, the amount is 1%. Okay. So 15 million into 50% into 1%, that is the amount that we will incur as a loss. So 15 million, we can't formulate it. No? So I'll write this 50 and 1% in a different cell. So you don't have to use your cal. Okay, so we're talking about into 50% into 1%. So the cost is 15 million into 50% into 1%. So the cost is 75,000. Okay. Other than this, we don't have any other cost. So after this, we only have benefits. Let's see, what's the benefit? Okay. So it's saying, if you introduce this policy, what will happen? 50% of your customers will pay within 30 days and another 30 will pay within 45 days. So to figure out what is the benefit is that you are going to get cash earlier. Okay. So to do a cost benefit analysis, this is the format that we always have to follow. Okay. So under the benefits, you will have current receivables and receivable days. Okay, what is the current receivables and the receivable days? If we get that, we can figure out how it's going to change if we introduce this discount. Right. So the current receivables is straightforward. It's given to you. That is going to be 2,466 given directly. Okay. Now we need to calculate the receivable days. Let's do that. So to calculate receivable days, it's going to be the receivables divided by, you should know, receivables divided by the sales into 365. Okay, so let me just write the sales here as well. So it's easy for me to formulate it. The sales will be 15 million. So we are doing this in thousands now. So let me write it as 15,000. Okay. So receivable days will be the receivables divided by the sales. We'll put that in brackets into 365. Okay. So the receivable days we are talking about is 60 days. It can't be 60.006. No? So let's consider the receivable days to be 60. Okay. So 60 days. Right. So for this receivables balance, that is 2,466, this is thousands. Okay. Because of this. I'll just write it like this. This problem again you won't have, guys, because we don't have Excel now. I don't want to waste time changing the money and all that. Okay. So this is going to all be in thousands. Right. So now you have to calculate the current finance cost. Okay. So what do we mean by the current finance cost? We are saying now these receivables are there, right? 2,466,000 receivables. Until they give me the payment, I have to actually take a overdraft or take a loan or do something and have this 2,466,000 in my hand. Because until the receivables pay me this amount, I will have to pay my payables, right? So I can't keep my payables and tell my suppliers, wait, I will pay you after my receivables come. So I have to anyway give my payments. So what I have to do, I have to probably take an overdraft facility for 2,466 since we're doing it in thousands. Okay. So this amount they tell us that we have an overdraft facility charging interest of 6% per year. Okay. So let me just put it like this to make things easier. 6%. So the amount that we are going to pay for our overdraft is this into 6%. Okay, so the overdraft we are going to pay $147,960. Currently, we are paying that amount. Okay. Now let's see what happens to our receivables and our receivable days if we implement this new policy. So revised receivables and receivable days. Okay. Now what's happening? If we implement this policy, our receivable days, which was 60, it's actually going to reduce. Okay, it's going to reduce. What is the new receivable days going to be? So they say that 50% of our customers, they will pay within 30 days. Okay, they say 50% will take the discount and pay within 30 days. 30% are going to pay within 45 days. Okay, so this is the customer and this is the days. And the remaining 20%, they will pay in the current payment. So currently they are going to take 60 days now. So they are not going to change their behavior. They will anyway pay within 60 days. Okay. So now let's get the revised receivable days. That will be this into this. Okay, so 15, 13.5 and 12. So we can take a total here. Okay, which is 40.5 days. Okay, so this is the revised receivable days. Okay. Now let's get the revised receivables. Okay. So we know that there is a formula like this, right? Receivable days should equal to the receivables over sales into 365. We know that there is an equation like this. Okay. You don't have to write it. I'm just showing it to you. Okay. For your exam, you can again use formulas. No problem at all. Right. So we know that there is an equation like this. We know that the revised receivable days are 40.5. Okay. So let me put the equal sign as well. We want to know what is the revised receivables figure. That's what we want. We know that sales is 15 million. So let's copy that here. Okay, that is 15 million. No problem. Then we have to multiply this by 365. Okay. So now you can use your cal. Usually when I am, when we are trying to find missing figures like this, I prefer to use the cal than to use formulas. Okay, because there is a chance that you can go wrong. I mean, you can do 40.5 multiplied by 15,000 divided by 365. It will give it to you. But sometimes you might go wrong. Okay, so that's why if it's not a straightforward calculation, I prefer to use the cal. Okay. So 40.5 should equal to, the revised receivables, that's what we have, over the sales, which is 15 million. Okay, which is 15 million. Multiplied by 365. So shift, solve, you get 1664. Okay. So since we're doing it in millions, let me quickly do something. Okay, hold on. Okay. So revised receivables, I'll put it in millions, okay, because I don't want to have a rounding error. I'm doing it this way because I don't want to waste time. Yes, yeah, you get confused. That's why when you formulate this, usually you get confused. 40.5, you have to divide it by 365 and multiply it by 15 million. It's a big figure. Okay, it's fine. I'll just use the cal itself. It'll be 1,664,384. Okay, if you use your cal, you will get this whole figure when you do it in millions. Okay, I don't want to put the formula again and waste time. You can try it on your own. You'll definitely get this figure. I tried to formulate it, but when you do that, I don't know. I don't know if it will work for you. For me, usually when the figure is too small or too big, like in this case, usually I have a problem where the formulas, it doesn't work out properly, especially when, it's a missing figure. Usually if it is a straightforward question, like here, for example, or when we got receivable days, here it's straightforward, no receivables over sales into 365, then you won't have a problem. But here, sometimes you might face a problem with the formula. So then you can use your cal and do it the way I did. The only thing is when I put it in first time, I put it as 15,000 instead of 15 million. That's why I got 101,664. Okay, so I wanted the whole number. So that will be 1,664,384. Just wanted to show you that. That's all. Okay. Right. So we have the revised receivables. Now what you have to do is take this revised receivables figure, because now this is the amount that you have to actually have in hand. You have to fund this by using an overdraft. So you can take this figure and get the revised finance cost. Okay, so let me. Overdraft was at 6%, if I'm not mistaken. So the revised finance cost will be this times this, which is 99,863. Okay. So let me bold this as well. Now you have to compare this revised finance cost with the current finance cost. So look here, the current finance cost is 147,960. Okay. But if you give the discount, then it becomes 99,863. Okay, so you can see that when you give the discount, what happens? The finance cost is actually reducing. Why is it reducing? Because more people are paying earlier. So less need for an overdraft. So overall, the amount of finance cost that you pay is actually less. Okay, so then you can calculate the savings in finance cost. So that will be, you can formulate it easily, which is this figure minus this figure. Okay, so that will be 48,097. So that is your savings in finance cost. Now the savings in finance cost, that is your benefit. Okay, so good idea to again highlight this. This is your benefit. This you have to compare with the cost, which was 75,000. Okay, So your savings is going to be 48,097, whereas your cost is going to be 75,000. Okay. Therefore, since the cost is greater than the benefit, the discount should not be offered to customers. Okay. So you have to compare basically this figure, 75,000. Okay, since that is referred, okay, 75,000, and this figure, which is 48,097. Okay, so the difference is how much? Let me check. Okay. So 26,903. So the cost is greater by this amount. The discount should not be offered. Okay. So that's how you do a typical cost benefit analysis. So I'll give you a second. If you have anything to take down, you can do that now. This is the format for a cost benefit analysis. You get 6 marks if you can do all of this. Okay. Okay, so I hope you've taken this down. Let's look at what the B part is saying. Right. So B is saying, they're talking about a completely different situation. They're saying calculate whether the bulk purchase discount offered by the supplier is financially acceptable and comment on the assumptions made by your calculation. So usually this bulk purchase discount, there are two situations. One is we are giving our customers the bulk purchase discount or early payment discount. Okay. In that situation, we will usually do this calculation, a cost versus benefit analysis. There is another situation where our supplier is giving us a discount. So then, if we have to decide whether we have to take the discount and pay early or not take the discount, you have to calculate the total cost of inventory. So we already did it in the previous question. You can have a go at this now. I'll give you 5 minutes. You have to calculate all three costs of inventory. That is the purchase price, the cost of ordering, the cost of holding, with and without the discount, and then you have to decide whether you have to take the discount or not. Okay. So I'll give you maybe 5 minutes. You can try to see if you can do it on your own. Again, 6 marks. Okay. So that's quite a bit of marks for that. Okay, so let me quickly start it up. So it says here, KXP currently orders 15,000 units per month. So whenever you're having these inventory-based questions, it's a good idea to type everything. So we can reference the sales now. Okay. So it's saying we currently order 15,000 units per month. So the quantity that we are ordering is 15,000 of product Z, demand for which is constant. So we don't know the demand yet. There is only one supplier of product Z and the cost of product Z purchases over the last year was 540,000. Okay. Then it's saying the supplier has offered a 2% discount for orders of product Z of 30,000 units or more. Each order costs 150 to place. So cost of ordering is 150 and the holding cost is 24 cents per unit per year. So 0.24. Okay. Right. Then they haven't given us the demand really, but they have told us that there is only one supplier and the cost of purchases over the last year was 540,000. Okay. So we don't have demand, but we know every month we are ordering 15,000 units. So that means for 1 year, we would order 15,000 into 12. Okay. So we would order 180,000. That would be our demand. So that's fine. Now we have to calculate, now to check whether this discount that they're giving for 30,000 units, is it worth or not? First, let's see what is the total cost of inventory. Inventory when the order quantity is 15,000 units, like how it is currently. Okay. So for total cost of inventory, there are three costs. We have the purchase price. Then we have the ordering cost. And finally, we have the holding cost. Purchase price is P into D, the price into the demand. But here it's given to us directly. They're saying it was 540,000. Ordering cost is going to be the cost of ordering. You should be familiar with these equations, guys. Multiplied by, it is going to be the demand divided by the quantity. So demand is 180,000 over the quantity that we are going to purchase is 15,000. So ordering cost is 1,800. And for holding cost, it will be the cost of holding multiplied by the quantity that we ordered, which is 15,000 over 2. These are the equations. Again, 1,800. So now we can take a total. Okay, so that will be this plus this plus this. 543,600. So this is the situation if we are going to order like how we are currently ordering at 15,000 units. Now let's do the same thing, but this time let's do it for 30,000 units because at 30,000 only we are going to get the discount. So at 30,000, let's copy this and make the changes. Okay. The quantity that we are ordering now, it's not going to be 30. It's not going to be 15. It's going to be 30. Okay. Demand will obviously be the same. Cost of ordering is the same. Cost of holding is also the same. Then we need to take these figures. So purchase price, they are going to give us how many percent discount? 2% discount. So 540,000. I'll just reference this. 540,000 into 2% means we are going to have to pay 98%. Sorry. 98%. Which will be 529,200. So earlier we used to pay 540. If we order in quantities of 30,000 or more, we get to pay a little less, 529,200. Ordering cost will be the same. Cost of ordering is 150 times the demand, which is 180,000 divided by the quantity. This time, okay, let me reference this. Okay. The quantity will be 30,000. So that will be 900. And here the holding cost again will be this multiplied by the quantity we are talking about, which is 30,000 divided by 2, which will be 3,600. So now we can take a total. Which is 533,700. Okay, so again, it's good to highlight it and bold it. Right, so if we take up the discount, we end up paying 533,700. If we take up the discount. If we don't take up the discount, then we end up paying 543,600. So we are paying more if we don't take the discount. Okay. Therefore, what's this company's name? KXP, right? Yeah. KXP company should take up the supplier's offer for a 2% discount because the total cost of inventory will be how many dollars less? 533,700 minus 543,600. The difference is 9,900. Cheaper. Okay. So let's see if we answer the requirement. It's saying calculate whether the bulk purchase discount offered by the supplier is financially acceptable. Okay, so we can say it is financially acceptable. Bulk purchase discount offer is financially acceptable. Okay. And comment on the assumptions made by your calculation. So let's talk about assumptions here. Okay. So the main assumption that something that struck me the moment I read here, they're saying demand is constant. Okay, we are saying that demand is constant. Now, in reality, demand can never be constant, right? It will keep on fluctuating. Okay, so one assumption that we are making, we make the assumption that demand is constant when carrying out our calculations. However, in reality, this assumption may not hold true. Okay, so you can just talk about one assumption, it's fine. Okay, there are other assumptions also. Okay, like for example, we assume that the lead time is constant. Okay, another one is we assume that the cost of holding and cost of ordering is equal. Okay, that also may not be true. Yeah, basically that's all they have mentioned in the marking scheme. So those three things, you don't have to mention all three. If you can just talk about one or two, that's more than enough. Okay, because only 6 marks, no, so obviously the calculation will itself hold a big portion. Right, so that's all for this calculation. You can take it down if you want. And then you can see in this question also, there's a trend, guys, where you will see at least 8 marks of the 20 being dedicated for theory. So see, the C part is something like that, where the entire 8 marks is entirely theory based. Actually, in this question, it's 50-50, right? Because even in the B part, there is a little bit that you have to write. Okay. So look at the C part. They are giving you 8 marks and they're giving you clearly 2 separate requirements. So if you're rationally going to think, we can, sort of split that 8 into 4 and 4. So we can talk about working capital investment for 4 marks and working capital financing for 4 marks. Okay. So let's see what they're asking. The question is saying critically discuss the similarities and differences between working capital policies in the following areas. 1, working capital investment. 2, working capital financing. Now, when I read it itself, the first thing I can think of is both are two different things. So, for 2 marks, I can easily explain what is working capital investment and what is working capital financing. That will give me 2 marks. After that, it will only be 6 marks for me to think about differences. Okay. So, let me show you how this looked like. So, this was, yeah. So, look here. The C part, it's saying working capital investment policy. So, we are talking first about working capital investment. It's concerned with the level of investment in current assets. Okay, how much we are willing to invest in our inventory, how much are we willing to invest in our trade receivables, how much are we willing to keep as cash. That is working capital investment. Okay, and usually working capital investment, we can compare one company with another. Okay, the second one that they're talking about is working capital financing. So that is a completely different, completely different area that we're talking about. It is not to do with the investment. We are wondering, okay, whatever our investment may be in current assets, how are we going to finance it? So working capital financing policy means what portion of our working capital will be financed by short-term sources of finance? What portion will be financed by long-term sources of finance? That is working capital finance. Okay, so if you can explain the two, the difference between the two, that will itself give you 2 marks. Okay, then they go into detail about working capital financing. They're saying working capital financing uses an analysis of current assets into permanent current assets and fluctuating current assets. Working capital investment policy does not require this analysis. So the first difference they're saying, if you're going to think about working capital financing, first we will decide whether our current assets are permanent or whether they are fluctuating. Because if it was permanent, then we will match that with a long-term financing source. That's what we do in working capital financing. If we have a permanent current assets like inventory or something, that's always a current asset, then we will try to finance that with a long-term source of finance. And if it's a fluctuating current asset, like maybe trade receivables or cash, then we try to source that with a short-term source of finance. So this act of, matching basically a long-term source of finance with permanent assets and a short-term source of finance with fluctuating assets, that matching principle is only done in working capital financing. It's not done in working capital investment. Okay, so that is the next point. If you see, working capital financing relies on the matching principle, which is not used by working capital investment. Finally, even in this point, they say working capital investment does not require the analysis between permanent or fluctuating. Okay, so that's one difference. Another thing about working capital investment and financing is, in both areas, we use the terms conservative, moderate, and aggressive. Okay, so if you look at the working capital investment, okay, then we will say, for example, one company is more aggressive compared to another if we have a low level of investment in current assets. Why? Because if we are having low investment, low inventory, low cash, low trade receivables, that means we are more profit oriented. So we don't want investment in working capital management. We don't want to be safe. We don't want to be conservative. We want to adopt an aggressive approach. Okay, so that's what it's saying. And vice versa for a conservative approach to working capital investment. So aggressive, conservative when it comes to working capital investment is about whether we are having a lower level of current asset or a higher level of current assets. Then it says in working capital financing, the terms are used to indicate the way in which fluctuating current assets and permanent current assets are matched to short-term and long-term finance sources. So if you're aggressive, That means fluctuating current assets and a portion of permanent current assets are financed by short-term finance. So if in working capital financing, if you are an aggressive person, then what will you do? You will try to source most of your finance by short-term, using short-term finance sources because it's cheaper. Remember, aggressive means we are always profit-oriented. So we try to go for a short-term source of finance because it's cheaper. But if you're conservative, then you will try to fund most of your current assets using long-term sources of finance because although it's more expensive, it is less risky. Okay, so you don't have to write so much. Now, at this point, we have written for 10 marks. But, I'm just telling you the different points that you can talk about. Okay. Then it says, finally, the two policies are very different in terms of their meaning and application. So if you look at here, working capital investment, we get 3 to 4 marks, and working capital financing also 5 to 6. So on average, if you can get 4 each, that will be more than enough. Okay. And even this part, see the comment on the assumptions will give you 1. And just saying that, the net benefit is, the bulk purchase discount, the benefit is greater than the cost, that will give you 1 mark. So don't ever forget to write down, the final outcome. So even an NPV question, for example, say accept the project, that will give you 1 mark. Here say the benefit is more than when we take the bulk purchase discount, so go ahead and take it. Okay. So you have to mention whatever is in your head, you have to mention it in words. Only then your examiner will give you that 1 mark. Okay. Right. So that is the 8 marks. Okay. In your exam, you have to, try your best to think of something. So how do we think of something? By doing more and more questions, and the more of these marking schemes you read, you will get a better picture of how to answer these questions. Right. So that is KXP. The last one for the day, let's do something to do with business valuations. Okay. So let me quickly choose the question. Let's do a question called Phobis. Let me go to that page 175. So that's about 175 is here. Okay, so why I chose this question is because it has a lot of calculations. So I don't want to bore you in the last hour. That's first thing. The other thing is it's a little, usually we will be very confident with this area. Market valuations, calculating market values of bonds and stuff. We'll be very confident with it. But sometimes the question, the way it's put, it might kind of make you get confused. Okay, so this is an example of a question like that. So what I want to say is the reason I'm doing this is in case you come up and see a question like this in your exam and you can't get a figure. Okay, for example, you're not sure of a particular figure. All these days we did it in one way, but in this question we are not getting the answer. We don't know what it is. Then just, guess a figure and continue the calculations. Okay, because there is this thing called own figure rule. So if you have a figure that it may be wrong, even then based on that figure, they will, give you marks for the rest of the calculation. So for example, let's say in the dividend growth model, one of the first calculations that we do is to calculate the dividend, D naught. Now, suppose in the question it's not given clearly, don't just get demotivated and stop there. Guess a figure even, put some figure, and from there, continue the question. That's what I'm trying to say. Okay? Right. So let's start this Phobis company. You can read it. They're giving you a lot of information in this question. Okay, what does it say? Phobis company is considering a bid for Danoka company. Okay, meaning Phobis is trying to buy Danoka. Both companies are stock market listed and are in the same business sector. So if they're in the same business sector, what you have to understand is their business risk is usually the same. So any equity beta, price earnings ratios, you can use it for both interchangeably. It's not a problem. Financial information for Danoka company, which is shortly to pay its annual dividend, is as follows. So remember, they have not paid the dividend yet. Number of ordinary shares, 5 million. Ordinary share price, ex-div basis, 3.3. Earnings per share, 40 cents. Proposed payout ratio, 60%. Dividend per share 1 year ago was 23.3 cents. Dividend per share 2 years ago was 22 cents. Equity beta is 1.4. Other relevant information, we have the average sector PE ratio, which is 10. The risk-free rate of return 4.6, return on the market 10.6. So you have to use CAPM ideally because we have equity beta, risk-free rate, market rate, everything is there. Then it's saying calculate the value of Danoka using the following methods. 1, use the price earnings ratio. 2, use the dividend growth model. Okay, so if you remember, let me see if I can find that business valuations slide. Yeah. Okay, obviously, we have summarized all of this, so shouldn't be a problem. I'll anyway show you once more. One second. Yeah, this one. Okay, this is a summary. Okay. So if you're going to value a business, I think I would have told you to write this down in class. It's just that now that I have a little more time, I have, put it in a proper slide. Okay. If not, I would have written the same thing and made you write it down in your books, right? So business valuation, we have 3 ways in which you can value a business. You can either go for the asset-based method, which is where we just basically add all the values of the asset. If they have a machine, a car, a building, everything, we just add the values of the assets and we say that is the market value of the business. A second method is we can go for an income or an earnings-based method. But remember, income or earnings-based methods, usually you can only use it if we are going to acquire a majority shareholding. Why? Because earnings or income, you can only influence it if you're a majority shareholder. If you're a minority shareholder, you really can't influence that. Okay. So when it comes to earnings-based methods, you have the PE ratio or the earnings yield. So PE ratio is your earnings into the PE ratio. Earnings yield will be earnings into 1 over the earnings yield. Okay. Then we have cash flow based methods. One is the dividend valuation model. If you are going to acquire a minority shareholding, then the only income that you really will get of significance is dividend. Okay, so then it will make more sense for you to use this model, the DVM. Or if you are going to go for a majority shareholding, then a better option would be to go for a discounted cash flow basis. So that will be similar to like an NPV style calculation. So this is the summary of the business valuation chapter. Okay. Now keeping this in mind, let's go to the question. What does it say? So they are saying calculate the value of Danoka using A, the price earnings ratio method. So let's start off. We know PE ratio means it's going to be the earnings multiplied by the PE ratio. Okay. PE ratio is given to us directly. How much was it? Let me see. PE ratio here, 10. So no worries, we can just put 10. Okay. What about the earnings? Have they given it to you anywhere directly? If you look at the question, we have ordinary shares, the share price, the EPS, the earnings per share. We have the payout ratio, dividend per share so many years ago and everything. But we don't have the earnings figure. Total earnings we don't have. But we have earnings per share. Okay, so let's just put this here. EPS, that was how much? 40 cents. That's $0.4. Okay. And we also have the number of shares. Okay, number of shares. How much is that? 5 million. Okay. So if I multiply the 5 million, basically the number of shares, by the earnings per share, I will get total earnings, right? Obviously. So I can get the total earnings. It's 0.4 multiplied by the number of shares. So the total earnings is going to be 20 million. Okay, let me include the commas as well. Or is it 20 million? No, it's 2 million, right? Let me check once more. 5 million into 0.4, yeah, 2 million. Okay, no need decimal places, okay? That is the total earnings. So if I want to know the market value of the company using the PE ratio, that is going to be the earnings figure. I'll put it here, multiplied by the PE ratio, which is 10. 20 million. So let me write it here. This is the PE ratio. So the value will be 20 million. PE ratio method, simple. 10 marks, right? This is 10 marks. So probably PE ratio will only be about 4 marks maximum. Okay. Then it's saying the second part to do the same thing, but this time to use the dividend growth model. Dividend growth model. Okay. Let me underline this. Try to keep things clean, guys, in your paper. It will definitely, depends on the, if you keep everything clean, then what happens is your examiner will anyway have a good impression. And that actually helps. Okay. So let me quickly go to the FM. Yeah, here it will be there. I just want to get the formula for the DVM. You should know it, but anyway. So this is the DVM formula. Given to you in your exam, right? That's where I had to copy it. This one. Okay. Right. So this is the formula for the dividend growth model. Now let's see what we have. D naught is the dividend that we are paying this year. D naught no this year. We don't have that. Growth also we don't have. Now to calculate growth, we can either extrapolate past dividends or we can use Gordon's growth model. But to extrapolate, we have two figures, that's good, but we don't know what D naught is. Now we have never come to a situation where D naught has been so complicated. We don't have RE also, cost of equity also we don't have. But cost of equity at least maybe we can use CAPM and find it easily, it looks easy. Okay. Now, in a situation like this, okay, first do what you know. KE you can calculate. Now we have the CAPM equation now. So KE equals to the risk-free rate plus beta times the market risk minus the risk-free rate. Whatever you know, first you calculate because these are also marks. Okay. I know usually we calculate the D naught first and the growth first, but in this case, it's not very clear cut. Okay. So now let's put all the figures. The risk-free rate, how much is that? 4.6%. Okay. Equity beta, that was 1.4. Then we had the return on the market, which is 10.6. Okay, so if we have everything to calculate KE. So put the equal sign. The risk-free rate is this much plus beta times return on the market minus the risk-free rate. I think it's to do with the percentages. Okay, so let's put it without the percentages. One second. Risk-free rate was 4.6 and later I just want to try if it works properly, that's all. 1.4 and 10.6. And let me try once more. Risk-free rate plus the beta times return on the market minus the risk-free rate. You can do all of this in your cal, guys, but I'm just checking if it's working, okay? What could be wrong? Okay. I'm not able to do it. If you can formulate it, then that's good. But if it's not working, then it's fine. You can always use your cal. Risk-free rate was 4.6 plus the beta, which is 1.4 times return on the market, which is 10.6 minus again the risk-free rate, which is 4.6. I think it would work if you put it as a risk premium, but it's fine. Since we don't have the risk premium directly, let's just put it in the cal. You should get that the cost of equity, it should be 13%. Okay. So let's just put it directly here as 13%. So we have KE. Now we have to figure out a way to get D naught, because without D naught, we can't even get G easily. Okay. So this is a little bit of a, you have to think a little, right? If not, you won't really understand how it works. So let me show you how to get that answer. 1 second. This is page number 175. Okay, so we have two figures. One, we have the EPS, the earnings per share, and we have the payout ratio. Okay, so let me just write the EPS equation. How do we usually calculate EPS? It's earnings divided by number of shares. That is the equation for EPS. And there's another figure that they're giving us, right? The payout ratio. So if you think about it, what is the payout? How do we calculate the payout ratio? It's the dividend per share divided by the earnings per share. Now, what do we want? We want DPS. We want the dividend per share. So using this payout, maybe it will be easy for us to get this figure. Okay. So let me show you. If we multiply the DPS also by number of shares. Okay, I'll show you what's happening. EPS also by number of shares. Shares, okay. So this is EPS information. This is payout information based on what was given in the question. Now let's say we multiply the EPS and the payout. Let's see what's happening. Okay, if you multiply these two, both are fractions. Okay, so what will happen? This EPS, which is the EPS into number of shares, that is obviously going to equal to total earnings, right? So this denominator and this numerator, they will cancel off. They will cancel off. It's a multiplication of two fractions. And then this number of shares, And this number of shares, they will also cancel each other off. So finally, when you multiply EPS with the payout, you actually end up with the DPS, D naught, dividend per share. Okay, so that's exactly what I'm going to do. So let me keep it as it is and see if I can cut it. So it will be, no, I can't because I don't have the pen. It's fine. But you should understand, right? This one goes off. This one goes off, the number of shares. The EPS and the earnings, they all go off. So ultimately, what we have remaining is just the DPS. Okay. So if I multiply the earnings per share, which was 0.4, with the payout ratio, which was 60, I will get the dividend per share. So 40 into 60%, that will give you 24 cents. That is going to be the DPS. EPS into payout. So as a rule also, you can remember that when EPS is multiplied by payout, you end up getting the dividend per share or the DPS. This is also D naught. Okay. Now for your exam, guys, for some reason, if you are not able to figure this out, okay, you are not able to figure it out, but you also know that D naught is not 22 or 23 also. Guess. Okay, it's increasing to 22 or 23, just guess 24. Okay, and just say, let D naught be 24 and then continue your equation. Don't ever make the mistake of getting stuck in D naught and then not knowing what to do. Okay. Right, so we have D naught now. Now we have to calculate growth. So to calculate growth, we need to use the past dividends. Yeah, that equation is not given. You should know it. What is that equation? Growth equals dividend, growth equals D naught over dividend n years ago, okay, this whole thing to the power 1 over n minus 1. Okay, so need the pen for this. You can formulate everything, but I won't advise because there's a very good chance that 1 over n and all, when you put it, you have to put it properly with brackets, okay? So these things, it's better to just use your cal and put in the figure. All right, so it's not allowing me to do it. Okay, it's fine. But I hope you know the equation. Let me do it with the cal and show you, okay? Right, so growth equals D naught, which is, we learned it was how much? 24 cents, over the dividend n years ago. So the oldest dividend that we have is 22 cents, which was 2 years ago. This thing, you have to put it in brackets. Okay, to the power 1 over n. So 1 over n. So n is how many years ago? 2 years ago. 2, the whole thing minus 1. So the growth in a percentage will be 4.45%. Okay, so here you can just omit this because it doesn't make sense. Let's just call it 4.45%. That's the growth. Okay. Right, so now we have D naught, we have G, we have KE. So all we need is to calculate P naught. So let's get P naught equals to, D naught is how much? We calculated it. It was 24 cents. So 0.24, let's do it in dollars. Times 1 plus G. We know that G is 4.45%. So 4.4. shift percentage, close it, over KE. So we got KE at the beginning itself, which was 13. Minus the growth rate, which is again 4.45%. One more thing, the calculator that you have at your exam, it has most of the functions, but you would see me like, putting X in certain areas and trying to solve for X. That function it doesn't have. Okay. Right. So P naught will equal to $2.93 per share. Okay. So the share price, market value, the share price is 2.93 per share, but they're asking me the total market value of the company. So I have to multiply this by the total number of shares in issue, which is 5 million. So 5 million into 2.93, that should give me 14,659,649 dollars, the market value of this company if you use the dividend valuation model. Okay, so let's just say here total market value, and you can put this figure. You can highlight it as well. Okay, so the only thing new in this question is how you will calculate the DPS or the D naught if it's not given directly. Okay, it's usually the EPS into the payout. Actually, that's the only other method that they will question. There are other ways. I'm not saying no, but the one that they like to question a lot is this one, EPS into the payout. Okay. But still, guys, we have not finished the question because it says, and discuss the significance to 4 bis of the values you have calculated in comparison to the current market value of Danoka company. So what you have to understand is, what was the company? 4 bis. If 4 bis is thinking of acquiring a majority shareholding, okay, if they're thinking of acquiring a majority shareholding, then this amount, which was this amount, the earnings into P ratio, which is 20 million. This was also market value, one method. The 20 million valuation will make most sense because if you are going to acquire a majority shareholding, then you can actually influence the earnings of the company. But if Forbes is only thinking about acquiring a minority shareholding, then it will be better off considering the market value to be 14,659,649. If you say that, you will have that is only the discuss the significance part. That itself will carry a mark. Okay, so always answer the question fully. So in this case, we have to say that if we are going for a majority shareholding, then it will make more sense to consider Danoka to be 20 million in value. But if you are going for a minority shareholding, then it will be more worthwhile to consider Danoka to be valued at 14.65 million. Okay, that's your 10 marks. Right, so that's all about the market valuation of that company. Now they're talking about a completely different situation. This one is a little important because it talks about everything to do with convertible bonds. Because usually questions will only ask for market value, but in this question, they are suddenly asking about flow value conversion premium. In our slides, we have done it. But in your exam, when you see it, you will remember that we did it. But since we didn't have any question that spoke about it, you might not remember how to do it. Okay, so let's quickly read this and see how to do B part. The first one is easy. I'll give you a chance. Maybe you can, since we have time, you can take 5 minutes. See if you can get the market value of the convertible bond. 6 marks, huh? Okay, let me start off. It says Forbes company has in issue 9% bonds. Okay, so interest is going to be 9% of nominal value. Okay, which is redeemable at their nominal value of $100 in 5 years' time. Alternatively, each bond may be converted on that date into 20 ordinary shares of the company. The current ordinary share price is 4.45 and this is expected to grow at a rate of 6.5 per year for the foreseeable future. Forbes has a cost of debt of 7% per year. They're asking you to calculate for $100 convertible bonds, the first one, the market value. Okay, so let's do that. So to calculate market value, first thing is you have to decide, are we going to convert this or are we going to redeem this? Okay. So first let's calculate the conversion value and then let's compare it with the redemption value. We know that redemption is at par, so that is $100. What is the conversion value? So it says here, they may be converted on that date into ordinary shares. And how many ordinary shares? 20. Current ordinary share price. So, ordinary share price is 4.45 and the growth, that will be 6.5 per year. So 6.5 means we are talking about 1.065. Okay, 100 plus 6.5, that will be 106.5. So if I write it as a decimal, it's 1.065. Okay, now let me calculate the conversion value. Okay, now how many years are we talking about? We are talking about 5 years. We are going to keep this bond for 5 years. Okay. So first let's calculate how much it would be in terms of the shares. So if you're talking about the market value of shares in 5 years' time, that will be 4.45 multiplied by the growth rate, which is 1.065 to the power 5. 5 years now. Okay. So the market value, it's going to become 6.09. Let's take it to 2 decimal places. 6.1. Okay, so that's fine. 6.10. And how many shares are we going to get? The total conversion value, that will be 20 shares. Each share will be worth 6.1. Sorry. So that is going to be $121.94. That's going to be the conversion value. Okay, that's the conversion value. And what is the redemption value? It's 100. Okay, so you can bold this and highlight it as well. This also bold and highlight it. Now, since the conversion option is higher, than the redemption option. What's this company's name? Forbes. No, wait. The bond holders will choose the conversion option. Okay. So now we know that we are going to convert, we are not going to redeem. So now we have to calculate market value. Let's do it step by step. We have the years, which is, let me see. Year naught, market value we don't have. So year 1 to year 5, we will have interest. Okay. Interest is always based on the 9%, the coupon rate. So 9% into 100 means interest is going to be 9. Okay. And then in year 5, we will have not the redemption, the conversion, which will happen at 121.94. Okay. Now you can have your discount factors at the cost of debt, which is 7%. Cost of debt is 7%. Right. Then year 1 to year 5, that's an annuity. So 7%, 5 years annuity. Okay, you should find that in the annuity table. That will be 7%, 5 years, it will be 4.1. Okay. And here year 5, the conversion is just one payment. So you have to find it in the present value table. The discount factor 7% for 5 years will be 0.713. The tables are given to you at your exam. Okay. Then we have the present value, which is this figure into this figure. You can get this. And then here you can have the market value, which is the addition. Let me make this to 2 dp. Okay, 1 is fine. So this will be this and this. 123.8. Okay, so the market value is going to be 123.8. Okay, so we have done the A part. Now they're asking for another figure and they're calling it, the second one, flow value. Can you remember what this is? What is a flow value? Any ideas? Flow value. We speak about it a lot. Okay. The flow value is basically the market value if we redeem this option. Okay. Now, usually a convertible, we will compare the conversion value and the redemption value, choose the higher one, which is what we have done here, and we calculate the market value. No problem. But if they are asking for flow value, it's the same thing, but only difference is that we want to know what is the market value going to be. Suppose we did not convert. Suppose we redeemed. Redemption. Now, suppose this was 100. We want to know what will the market value be. Simple as that. Okay. But then we don't call it market value because if you're a rational investor, you won't redeem, you will convert it. Okay. But we just want to know what will be the market value if we redeem. Suppose there is a redemption. Then you will just change this in year 5. Instead of conversion, you will have a redemption. But remember, we don't call this market value. We call this the flow value. That's the only difference. We call it the flow value. And now since everything is formulated, you don't have a problem. If you change this redemption, this conversion to 100, everything automatically changes. Well, that's the flow value, simple. Third one. What are they asking for? They're asking for the conversion premium. Can you remember what a conversion premium is? There was an equation for it, okay? It's the market value minus the current conversion value. Market value minus the current conversion value. So what is the market value? We have it here, 123.8. Current conversion value means at the current market price, which they told me, it was 4.45, right? If I were to convert, if I were to buy those, if I were to get those 20 shares at the current market price, what will the value be? So simply that is 4.45 times 20. Okay. So 4.45 times 20 is 89. So conversion premium is 123.8 minus 89. Simple as that. Okay. So let me Okay, let me write it here. 123.8 minus 89, which is 34.8. Okay, so this you can just write here as, because it's not very clear, let me do this. This is the current conversion value. Okay, so current conversion value is 4.45 into 20, which is 89. Okay, and here maybe as a heading you can say market value. And here you can say as another heading, you can say current conversion value. Okay, and here you can call it the conversion premium. Okay. At your exam, at your exam, don't do this. I'm just showing this to you because I want you to know what is happening. At your exam, even if you just write it there and formulate one or two, it doesn't matter because your examiner has access to your formulas, so he can find out how you got the answer. Okay, so here I'm doing it because when you're copying it down, you have to know what I'm actually talking about. Okay, because when you change the size of the column like this, the other questions that you do, it shouldn't get messed up. In your exam, it won't happen because market value, you'll have a spreadsheet usually under that. Flow value, it will be there separately, conversion will be separate. But if you find that while you're making the adjustments, the ones on top are getting messed up, then by all means, just type it. Okay, no problem because it's a small calculation. No? So 123 minus the current conversion value 89, it should give you the premium 34.8. Okay, that should give you your 6 marks. It's simple 6 marks. Finally, it's saying discuss the significance to a listed company if the stock market on which its shares are traded is shown to be semi-strong form efficient. Right. So when it comes to market efficiency, there are there are 4 types of market efficiency. Okay. So because I'm explaining it, I'm typing it. You don't have to write this in your exam. One is it's not efficient at all. Another one is it's weak form efficient. Then you have a semi-strong form efficient. And then you have a strong form efficient. Please learn all of them. Okay, wherever you have the notes to do with them, please learn it because they have focused on this area in the pre-mock. Okay, so not efficient at all means the share prices in the stock exchange, you can only predict anything using the past share price, meaning it's not reflecting any information from the company at all. Absolutely nothing is reflected. Okay, that is not efficient at all. Weak form efficient means it reflects the past. Obviously, you can take a decision based on the past share information because even in not efficient, you can do that. But in addition to that, it includes information from the company like, their financial statements. Okay, so anything that is showing in the financial statements, a profit, a loss, a lot of working capital problems, all of that will be reflected in the share price in a weak form efficient market. Okay, semi-strong form efficient means okay, this is, it reflects both the information that is in the statements, okay, the information from the previous share prices plus any publicly available information. So for example, if they announce something, they just announced maybe them investing in a new type of product or a new project, any public information that is available, it will be reflected in the share price. strong form means all publicly available information plus any inside information or private information. For example, the board of directors took a decision. They didn't announce it. It was inside them. They knew it was private information. But if it is a strong form efficient market, then even private information will be reflected in the share price. Okay. So if you can explain, just now here they're asking only semi-strong form. No? So if you can say that the share price of the company in the stock exchange, it will reflect all publicly available information, that will give you 1 mark, because that is defining what a semi-strong form market means. Okay, so that is the first point you can say. Then you can say, I'll show you the marking scheme. I'm looking at it right now. I'll quickly go there. 527 means, let's go 550. Yeah. So if you look at this here, stock market efficiency usually refers to the way in which the prices of traded financial securities reflect relevant information. Okay, so that they're talking about a very general point. They're saying stock market, its efficiency talks about how well the share price reflects relevant information. Then they're saying when research indicates that share prices fully and fairly reflect public information as well as past information. So past share prices, the financial statements, all of that. A stock market is described as being semi-strong form efficient. So if you can say that, that's another mark. Then they ask, what is the significance now to a listed company? So it's saying the significance to a listed company of its shares being traded on the stock market, which is found to be semi-strong form efficient, is that any information relating to the company is quickly and accurately reflected in the share price. Okay, so the significant to the company is any relevant information that actually will cause a change in share price. If it is publicly available, then in the stock market, the share price will automatically reflect that information. Okay, so that is what you have to say for your 3 points. If you want, there's another point, they haven't mentioned it here. You can also say, however, if it is a strong form market, any private information will not be reflected in the share price, and so you can benefit from insider dealings. Okay, so if you get inside information from somewhere, you can benefit from that in the share market. However, many governments have claimed it. I mean, they have basically, what's the word I'm looking for? They have banned insider dealings. Okay, so it is illegal for you to actually use inside information and take decisions based on that. If you say that also, there is 1 more mark, but they haven't mentioned it very clearly here. Okay, so if you can see, definition of semi-strong form efficiency, 1 to 2 marks. Significance, 2 to 3 marks. Right? Okay, so it's fine. So that's all for that particular question. Right, it's 9:02. I'll call it a day and I will see you at a TRG next week. What will I do next week? I will hopefully go through a particular paper like a mock exam style. So I will do a few MCQs and I will do the constructed response as well. But I might, skip a few questions here and there because I only have 3 hours. I can't go through an entire paper in 3 hours. But since we haven't done MCQs and MTQs, I will focus on that more than the constructed response, because constructed response at this point, we have done 3 questions every day. So we have done, actually not 3, one day we did 4. So we have done 10 questions. That should be enough and more for you to, be confident with yourself. Okay. So I'll see you next week at 6 to 9. And the one Shagana, please make sure that you do the pre-mock. If you have any questions, you can reach out to me on Tuesday. Okay.